If you are thinking of consolidating your debts, especially if you're thinking of doing that using any type of secured finance, such as mortgages or anything like that, then hopefully I'm going to be able to answer a couple of questions for you and give you things that you should look out for, our pointers during the application, um, to make things easier and hopefully give you a little bit of a better chance of success. So today we are going to be specifically looking at consolidating debts using a mortgage to try and help you save money on a monthly basis. And more importantly, we're going to look at the pros and the cons of it to make sure that you understand exactly what you're getting yourself into. And we're going to do that right now. So we're going to jump straight into this and we're going to look at the things that you need to look out for and the things you need to know when you're using or considering using a mortgage to consolidate your debts. So let's talk about debt consolidation first of all. What is it? How does it work? So consolidating debts is basically the process of putting lots of smaller debts into one individual loan. And one way of being able to do this is by using your mortgage or using your property. And there's a couple of reasons that you do that. And generally, you can take it over a longer term, which means that you can lower your payments. If that's what you're aiming for, then that's a great way of doing that. And there's different types of ways you can do this. Yes, we fundamentally look at mortgages, but it's important that we tell you that there are other ways to do this. So yes, you can consolidate using your mortgage. You can consolidate using something called a second charge or a secured loan. But there's other ways. You can also consolidate using unsecured loans. There are also other routes available, such as debt management plans, and things like IVAs or even bankruptcy. Now, obviously, we can't go into that on here, but it's important we tell you they exist. Now, anything that is managing your debt, so debt management plans, IVAs, or there's another one called a debt relief order, they will affect your credit score. So it will affect your credit file and your ability to get credit, including a mortgage, for a good number of years to come. So if you are going to go down that road, it's important that you know that and understand that could potentially cause you problems later on down the road. Now, one of the reasons that you'd obviously look to consolidate debt not only is to reduce your monthly payments, but it also hopefully will manage or reduce what you're actually paying on your debts right now. Now, the only time that doesn't really work very well is if you're very good at moving your debt around. So if you've got credit card debt, for example, that's currently on a zero rate. So let's say you've got £20,000 outstanding and it's currently on a zero rate credit card, you're probably not going to beat that by moving it on to a mortgage. Well, you're not going to beat that by moving on to a mortgage because obviously you're paying 0% interest. So you should utilize that for as long as you possibly can do. Now, have we ever consolidated debt which is on 0%? Yes. And sometimes there's a really good reason to do it. And mainly that's around monthly payments. So even though it's on a 0% interest, if you are struggling with the monthly payments or you need more disposable income, then the reason you'd put it all into a one loan is to reduce that monthly payment. And it also only gives you one monthly payment. So rather than having to juggle and monthly payments around with various different credit cards, various different loans or whatever you've got, consolidating everything together does give you that one payment. So it does allow you, I suppose, to budget that little bit more effectively than having payments sort of coming here, there, and everywhere. So that's loans and credit cards and how you manage and how you can manage things. So that covers sort of what is debt consolidation. But what about using a mortgage for it? And more importantly, how do you use a mortgage for debt consolidation? Surely a mortgage is just to buy a house. Well, that really depends on the equity that you've got in your property. And what I mean by equity is, let's say your property is worth £100,000 and you've got a mortgage which is worth £60,000. So you owe the £60,000 to the bank, but that £40,000 that remains, that's the equity. In theory, that's your money. That's the bit of your house that you own. And there's various different ways you can get access to that. And that's the bit that you use when you come to debt consolidate. So let's say that you needed to debt consolidate £15,000. When you next go to remortgage, instead of just applying for £60,000, which is what's on your current mortgage, you would apply for 75. So you basically use the £60,000 to pay off your existing mortgage, and then you use the 15,000 to pay off your debts. Now, it's important to realize that by consolidating debts together, especially taking money out of using your mortgage to do anything, whether it's home improvements or debt consolidation or whatever, in theory, you're going to be paying more interest in the long term. And the reason for that is, even though you're paying the minimum payments on your credit card, or assuming you're paying the minimum payments on your credit card, then the mortgage is generally taken out over a far longer term. So let's say that you take your mortgage over 25 or 30 years, for example. When you add up the interest over that 30-year period, as a general rule, you're going to be paying more interest. Is that always true? No. But it's worth doing the calculation to really understand whether, that could potentially be true. And you need to make sure that you understand, whether it's worth doing for you. Ultimately, if you need to be reducing your monthly payments, then it's something that inevitably you won't have a choice about. But it's important you understand that is what is going to happen. Now, let's have a look. So when you apply for a mortgage, and you're looking to consolidate debts, different lenders will have different rules as to what you can actually consolidate. And this is going to be down to things like LTV limits, and loan to value limits, so how much you can borrow versus how much your property is actually worth, and it's going to be down to things like how much you're looking to consolidate. So different lenders have got different criteria. So some lenders, for example, will say you can't consolidate more than £50,000, or you can't consolidate more than 8 debts or 10 debts or 12 debts, regardless of their value. The other thing that you need to look out for is the way that mortgage lenders will ensure that you need to pay these off. So some mortgage lenders will ask you to sign something that basically says, I promise to pay my debts off. Other mortgage lenders will put a condition in the mortgage for the solicitor to do it. Now, the problem with the solicitor doing it is the solicitor wants to charge you, or some solicitors, let's not say that they all do it, but some solicitors, most solicitors, will charge you in order to do that, and they charge you per debt. So if they charge you anywhere between, I don't know, 35 and £50 per debt, and you've got 20 debts to pay off, that's a big chunk of cash that you've then got to find in order to do it. So you need to make sure that you work that out and take all of the costs into consideration, because the mortgage lender, whoever you're using, especially if you go direct, they're not going to tell you about that. They don't need to tell you about it, because it's not their charge. It's a solicitor charge. Now, not all lenders do that. It does vary throughout the market, but it's really important that you check what lender does what. And it's impossible for me to go through it on this video to tell you what lender does what, because it changes all the time. You just need to check with them as and when you're going through this. Or, of course, a mortgage broker will do these things for you. So obviously, let's just touch on mortgage advisors for a second. We've been doing these. Well, I've been doing this for sort of 15 years plus. Whatever mortgage advisor you choose to use is going to have the experience and the knowledge to be able to tell you these things, so that they don't become a surprise later on. And more importantly, it's a good idea to get these things right first time, because what you don't want to do is you don't want to start this process and then get halfway through it, or nearly to the end, and then find out actually this doesn't work, or this is not cost effective enough. And then either you have to proceed with it because you've run out of time, so you just need to go ahead regardless if it's the right financial decision or not, or you'll get to a point where the lender says, well, actually we can't help you anymore because of something that they probably should have asked in the beginning. So it's really important that you make sure you get these things right and get them checked up front. Now, before you go and apply for a mortgage, and especially one to get or to consolidate your debts, if I can find my words today, what you need to do is to get all of your stuff together. So one of the best tips I can give you when it comes to consolidating debts or mortgages in general is to make sure you get all your documentation right. So before you do anything, make sure you've got your passport, you've got your driving license, you've got your bank statements. Generally, you'll be asked for the last 3 months, your last 3 months pay slips. And then when it comes to debt consolidation, make sure you get, if you're consolidating credit cards, get all the latest credit card statements together, because we're going to need that in order to work out what it is that you're looking to consolidate. Get all of your loan statements together, because obviously when you take out a personal loan, if you pay it off early, then you, depending on how the lender works, you may get a refund of interest. So it's important you get a settlement quote for your personal loans rather than just the balance on them, because they can sometimes be different depending on the size of the loan and the interest rate you're on. They can sometimes be thousands of pounds different, which is obviously going to have a huge impact on the amount that you need to borrow. So again, make sure you get those together. And it's important, especially when you debt consolidate, that you tell us about everything. So don't tell a lender, not tell anybody about all the debts you've got, because everything will be considered, especially when it comes to affordability. And affordability is essentially what the lender's willing to lend you based on their calculations of how much you can afford to pay every month. They will base it on, or some lenders won't actually take into consideration what you're actually paying off. So let's say you're paying off £20,000 worth of credit card debt. Some lenders, even though they lend you the money to pay it off, won't consider that within the affordability calculation. So sometimes you can approach them and they'll turn you down based on debt you won't have at the end. Now, I can't explain why they do that because it makes no sense to me, but be wary of that, especially when you're making an application. When they're going through the affordability checks, don't be disheartened if they suddenly say, well, I'm very sorry, but we can only lend you £1 or something ridiculous. Ask them, are they considering that you are consolidating debt? Because not all of them do. So don't be discouraged to move to the next lender. Again, our mortgage advisor should know this anyway, and we'll go through these things for you. Coming on to things like, let's talk about mortgage advisors and especially fees, because essentially, well, why would you pay a mortgage broker a fee when you could do it yourself? I've done a couple of little videos on this recently, but so I've got a good little illustration here, which is good, cheap, and fast. And you can only generally pick 2 out of those 3 options. So if you want something good or something cheap, that's generally not very fast. If you want something cheap and fast, it's generally not very good. And when it comes to paying fees, then this is the way that I think you need to consider it. And I'd say this regardless of whether it's mortgage advice or paying an electrician or a plumber or whatever. Then you need to consider this, because regardless of somebody saying, yes, I can do something for free or whatever, ultimately we've all got to make a living out of this. And the way that the mortgage market works, I'll let you in on a little secret here. We get paid a percentage, a very small percentage, but a percentage of the amount that you borrow. So if you're only borrowing a small amount, sometimes we'll earn £100, £150, and it's simply not enough to keep the lights on and to keep doing this every day. And the way that some brokers will sort of counteract that is they'll take on more business. And there's nothing wrong with that. That's their business model, and that's absolutely fine. But here we will always look at service. So there is always a trade-off between service and the fees that we charge. And unfortunately, just due to what we get paid in commission from the lenders, as a general rule, it's just not enough to keep the lights on and keep the service levels where they need to be. So fees is a big thing to consider, especially if you are looking at a mortgage broker doing this for you. Of course, if you're not looking for a mortgage broker and you're looking to do this yourself, you need to follow everything, obviously, that I've said in this video, or try and follow it as much as you possibly can. And it will avoid, obviously, certainly a broker fee, but you'll have all the other fees. You'll still have lender fees and product fees and solicitor fees and everything else. So that's everything there. So yeah, that's everything for today. Hopefully that explains what it is that a mortgage broker does, how you consolidate debts using a mortgage. And obviously, if you like this, please drop any comments on this below, and I'll try and come back and I may even answer that in a future video. And yeah, if you want to follow, subscribe to the channel, click like, whatever it is, you know what to do by now. And yeah, I'll see you soon.